Hi, thank you for having me. Matt Weinstein. I'm the co-chief investment officer at Axonic Capital. We're a New York-based asset manager, manage about $8 billion of assets, a handful of different pockets of capital, everything running from publicly registered vehicles to insurance capital to private funds. And our focus is on the real estate markets, real estate debt, opportunistic real estate, and then the structured credit markets as well. Yeah, so we've certainly seen material changes in the real estate debt landscape. I think it probably first started with regional banking crisis of a few years ago, and I think with potential exit of conservatorship, privatization of the GSEs, we've certainly seen things accelerate. The way that we like to talk about it is what we think we're seeing in the real estate markets today is akin to probably what you saw in the corporate private credit markets a decade plus ago, where the shift from more traditional lending sources back then with a lot of bank balance sheets to alternative private lenders was a intended consequence of regulation, right? That is what the regulators wanted to do. They thought it was a shifting of risk in a prudent manner. We think that's exactly what you're seeing today in the real estate markets, where you're seeing a lot of the large incumbents, the GSEs in particular. If you look at multifamily debt stock, between the GSEs and banks, that's almost 80% of the 2.2 trillion of multifamily debt that's out there. So it's a massive percentage of the market. Even a small shift away from those incumbents obviously has material implications for alternative lending sources. And so I think what we're seeing is, number one, we are in the early innings that we think will accelerate of a shift away from incumbents. I think they'll continue to have the dominant market share, but if that goes from 80 to 60%, that is hundreds of billions of dollars of loans that will shift to alternative lending sources. Number two, it probably has some implications for cost of capital. On the margin, you could see higher risk premiums, the way that banks tend to win with low interest rate recourse loans. GSEs tend to win with lower cost of capital. So we think on the margin, that could mean slightly higher cost of capital for real estate. So, from where we sit, I think we think of the segmentation of the multifamily market sort of three different verticals. So you have what we would call small balance, middle market, and then large balance. What's interesting is if you look at the progression over the last few years, what is happening on the small balance side in a lot of ways has remained the way it was. It's a super fragmented market. A lot of borrowers take recourse loans. Even when Fannie and Freddie were at their peak in the small balance market a few years ago, they were still never more than 8 to 12% of market share. So it's just going to continue to be a fragmented market where we think there's not a material impact with the GSEs pulling back. Large balance side, very different in the sense that large balance recourse is incredibly uncommon, but you have very, very large institutional players who have a material and consistent access to capital. And what we're seeing there is, again, not a massive shift in the way that those type of transactions are banked. And where we are seeing the most acute difference is in what we would call the middle market, anywhere from $15 to $75 million loans. That is actually where you see the most volumes on a typical year. That could be by volume, 50 to 75% of the deals that are done. And that is really where folks like Fannie and Freddie have the most impact. These are still institutional sponsors and high quality assets, but they tend to be much more localized, own fewer apartments, and don't have the same scale in terms of reaching the mega lenders. So we're definitely seeing the most shift there, and that's where Axonic as an institution is definitively most focused. We think that the real opportunity set in front of us is to step in and capture market share in the middle market multifamily lending world. So, I think we're seeing it in a handful of different ways. So it's certainly, the really broad and simple answer is alternative capital. What does alternative mean? So if banks and GSEs market share is going to go down, who's going to go up, right? Who are those alternative lending sources? I think it is a lot of the folks that have existed previously. They're just going to increase their market share. Insurance lenders, there's a lot of innovation happening in the insurance space. Axonic has an insurance business, Axonic Insurance, where we do direct commercial real estate lending on their balance sheet. We're not alone in pursuing that, and I think that's unequivocally an area of growth where you'll see, given the pullback in banks and GSEs. Number two, sort of more traditional private capital lending vehicles. That's certainly where we're doing a lot of our multifamily lending and non-multifamily lending out of. And the last source is we think we'll probably see some growth within the CMBS markets. So, when we think about the market and what gives Axonic its edge, the term that we like to use is horizontal integration. And so, you'll hear the term vertical integration a lot when you're talking about real estate owner operators. We like to say we're horizontally integrated. And all we're trying to say there is that if we look at a particular real estate transaction, we could look at it through the lens of being a senior bond buyer, a junior bond buyer, a senior mortgage lender, a subordinate debt lender, or we can own the equity outright. And we think that gives us a really unique advantage to be this flexible source of capital. And so if you think about where the market is migrating, where we're going from sort of more traditional incumbents to more alternative sources of capital, at an overall time in the market with real estate valuations, if we talk about multifamily, are down on average, 10 to 30%. There is, capital that needs to fill these capital structures. Being a flexible, horizontally integrated lender probably is more relevant today than it's ever been. And it's the business that we've always built. It's just particularly sort of acutely important today. And so I think that ability to be capital structure agnostic, horizontally integrated, is incredibly valuable. And so when we think about where are the most compelling opportunities, it's really sort of twofold. Number one, it is, as I talked about earlier, it's middle market multifamily lending, both stabilized and transitional, as well as, we have launched recently a construction program, again, focused on the middle markets, where it's just another part of the capital markets where we're seeing a void for traditional capital. So that's sort of number one. It's middle market, multifamily focused lending. The second is, what I call sort of more opportunistic capital, targeting higher returns, done out of more sort of locked up traditional vehicles where we can come in, fix a broken capital structure, help fix a broken asset, install a condo project, whatever sort of the asset is, and you can make returns today that are, high teens, low 20s, when historically that used to be sort of 12 to 15%.